You just got paid, and the first thing that left your account was a bill. It is a modern cycle of financial dependency that feels almost impossible to break, leaving most people feeling like passive passengers in their own economic lives. But imagine a different starting line. A boy in rural New York got paid for the first time in his life, and the first thing he did was write down every single cent in a small ledger, then give 10% of it away before he spent a dime on himself. That boy became the richest man the world had ever seen. He was not born into money. He was born into a household so unstable that historians still argue about how his own father made a living. So what did he actually understand about cash that almost nobody else in his position understood? Stay with this one, because the answer is not about luck, nor is it about basic corporate greed. It requires looking past the historical caricature of a ruthless billionaire and stepping directly into the psychological laboratory where his internal blueprint was formed. John Davison Rockefeller was born on July 8, 1839, in Richford, New York, into a household defined by two people who could not have approached money more differently. His father, William Avery "Big Bill" Rockefeller, was a traveling salesman who sold everything from lumber to patent medicines of dubious effectiveness. He was frequently absent from the family for months at a time, and by most historical accounts led a double life that included bigamy under a false name. He was, by nearly every definition, financially unpredictable, sometimes flush with cash, sometimes vanished entirely, leaving the family to fend for themselves in near total isolation. His mother, Eliza Davison, was the opposite in every respect. Deeply religious, rigidly disciplined, and famous within the family for a phrase she repeated constantly to her children: "Willful waste makes woeful want." Young John did not grow up with a stable income. He grew up watching one parent create financial chaos and the other parent impose relentless order on top of it. To truly understand John, you have to realize that this wasn't just a preference for neatness or a childhood chore. It was a profound psychological survival mechanism. As a boy, watching his father vanish for months and his mother quietly panic over how to feed the children, John associated financial chaos with an existential threat. The ledger he eventually created wasn't just a book of numbers. It was an emotional shield against the world. Inside his young mind, a terrifying and unshakable realization took root. If he did not master every single penny, the unpredictable, volatile cruelty of the world would eventually swallow him and his family whole. By the time he was a teenager, he had clearly chosen which parent's approach he intended to live by. This split is worth pausing on, because it maps directly onto a concept modern financial psychologists call locus of control, the degree to which a person believes their financial outcomes are the result of their own actions versus outside forces and luck. Children raised around unpredictable income, research on financial socialization shows, often develop one of two responses. They either develop a fatalistic belief that money simply comes and goes regardless of effort, leading to impulsive spending habits in adulthood, or they develop the opposite, an intense, almost protective need to track, control, and account for every single dollar that passes through their hands. Rockefeller developed this second response so completely that it became the rigid foundation of his entire adult life. Before you build a single financial habit of your own, it is worth asking which of these two responses your own upbringing pushed you toward, because that quiet instinct is likely still steering your relationship with money today, whether you have ever noticed it or not. But tracking his pennies was merely a symptom of a much larger internal engine. His real breakthrough wasn't just how he recorded his money. It was the deeply counterintuitive way he forced his cash flow to move before he even had a real business to manage. At the age of 7, Rockefeller earned his first income raising turkeys, which he sold to neighbors, and he began lending small sums to other children at interest, a habit his own mother reportedly encouraged rather than discouraged. But the defining financial artifact of his early life came at age 16, when he began keeping a small red notebook he called Ledger A. In it, he recorded every cent he earned and every cent he spent, in careful, obsessive detail. His first real job was as an assistant bookkeeper for a Cleveland produce shipping firm called Hewitt and Tuttle. which he started in September of 1855, initially working without pay for several weeks simply to prove his worth, before being hired at a wage of roughly 50 cents a day. His full first year of work earned him approximately $300. From that very first paycheck, he gave away 10% to his church, a practice known as tithing, and continued doing so for the rest of his life, eventually donating well over $500 million to charitable causes by the time of his death. Decode what actually happened inside Ledger A, because it is not a story about generosity, it is a story about cash flow mechanics. Rockefeller treated that 10% tithe the exact same way modern financial planners recommend treating a savings or investment contribution, as a fixed, non-negotiable line item that got paid before anything else, not whatever happened to be left over at the end of the month. Financial researchers refer to this as paying yourself first, and the mathematics behind it are brutally simple. If you wait to save whatever remains after all your spending, your savings rate tends to drift towards zero, because spending naturally expands to fill whatever is available, a pattern economists call Parkinson's Law applied to personal finance. But if you remove a fixed percentage the moment income arrives, before it ever touches your checking account, your spending simply adjusts downward to what remains, almost invisibly, within a matter of weeks. Rockefeller was not merely being pious with that first 10%. He was training himself, at 16 years old, to treat commitment to future goals as more urgent than present comfort, a habit he then applied to every dollar he touched for the rest of his life. In 1859, at just 19 years old, Rockefeller left his bookkeeping job and partnered with a young Englishman named Maurice Clark to start a produce commission business, Clark and Rockefeller, buying and selling grain, meat, and other goods on consignment. He needed $1,000 of startup capital and had only about $800 saved. He borrowed the remaining amount from his own father, Big Bill, at 10% annual interest, a rate his father charged him despite being his own son, which Rockefeller later said taught him an early and valuable lesson about the true cost of capital. The firm succeeded quickly, and by its first full year of operation, had handled products worth roughly $450,000, an enormous sum for the era. Rockefeller's role in the partnership was rarely the charismatic sales side of the business. It was almost entirely the ledgers, the contracts, the meticulous tracking of margins on every single transaction, down to the penny. This detail matters more than it seems, because it reveals something counterintuitive about where fortunes are actually built. Popular culture tends to glorify the dealmaker, the salesperson, the visionary pitching the big idea. But the historical record on Rockefeller shows something different, that his primary advantage in these early years was not persuasion, it was precision. He tracked cost per barrel, cost per mile of transport, and profit margin on every single line of the business with an intensity his partners found almost strange. Modern small business data tells a remarkably similar story today, that businesses which closely track unit economics, the actual profit or loss on every single product or transaction, consistently outperform businesses that only monitor total revenue. Total revenue can look impressive while margins quietly bleed the business dry underneath it. If you run a business or even manage a household budget, the question is never simply how much money came in this month. It is what did each dollar of that money actually cost you to generate, and did you track it closely enough to know the difference between a profitable transaction and one that only felt successful? The event that changed the entire direction of Rockefeller's life was the discovery of large-scale petroleum extraction in western Pennsylvania in the years following 1859. Kerosene refined from crude oil was rapidly replacing whale oil as the primary source of household lighting across America, and the refining business, chaotic, unregulated, and full of small competing operators, caught Rockefeller's attention as an opportunity almost nobody else was approaching systematically. In 1863, he and his partners invested in a small refinery in Cleveland, and by 1865, at the age of 25, Rockefeller made a decision that would define the rest of his career. He bought out his produce business partners entirely and committed himself fully to oil refining, a business he considered dangerously volatile but mathematically full of opportunity for anyone willing to bring order to it. Here is where the second major financial mechanism of Rockefeller's empire begins, a concept called vertical integration, and it deserves careful, plain English decoding because it is one of the most powerful and underused wealth-building ideas available to anyone running a business today, even a very small one. In a typical business, you buy raw materials from one company, pay a separate company to transport them, pay another company to package them, and pay yet another to distribute them to customers, with each of those companies taking their own profit margin along the way. Rockefeller looked at the oil industry and asked a deceptively simple question. What happens if I own every single one of those steps myself, instead of paying someone else's profit margin at each stage? He began acquiring not just refineries, but the barrel-making operations that supplied his refineries, the pipelines that transported his oil, and eventually negotiated extraordinary rebate deals with railroads by guaranteeing them massive, predictable shipping volume. Each acquisition did not just add a new revenue stream. It eliminated a profit margin he had previously been paying to someone else and redirected that margin back into his own company. Run the actual arithmetic of vertical integration on a simplified scale, because the logic applies whether you are building an oil empire or a small local business today. Imagine a company earns 10% profit margin on its core product, but currently pays 3 separate outside vendors for packaging, transportation, and distribution, each of whom also earns roughly 10% margin on their piece of that same supply chain. If that company acquires even one of those 3 vendors, the 10% margin that vendor used to keep disappears as an expense and becomes profit instead. The company has not sold a single additional unit of product. Its total revenue may not have changed at all, but its overall profitability on that exact same revenue increases substantially, simply because fewer outside parties are taking a cut along the way. This is precisely how Standard Oil, the company Rockefeller formally founded in 1870, grew to control an estimated 90% of American oil refining capacity within just over a decade, not primarily by selling more oil than everyone else, but by capturing more of the profit margin embedded in every barrel it touched. Rockefeller's personal habits throughout this period of explosive growth remained almost eerily consistent with the disciplined teenager who kept Ledger A. He continued to review company accounts personally in extraordinary detail well into his later years as head of Standard Oil, reportedly able to identify discrepancies of a fraction of a cent per barrel across enormous shipments. He lived, particularly in his early career, well below what his growing income would have allowed, continuing to tithe consistently and investing the overwhelming majority of his profits directly back into acquiring more of the supply chain rather than into personal luxury. This reinvestment pattern is worth translating into a number you can actually use. If you earn additional income this year, a raise, a bonus, a side business profit, and you reinvest even 50% of that new income into an appreciating asset rather than absorbing it entirely into lifestyle, you are following the exact structural pattern that built Standard Oil, redirecting margin into more margin, rather than converting margin into consumption. By 1882, Rockefeller had consolidated his various oil holdings into the Standard Oil Trust, an organizational structure so effective at eliminating competition that it eventually triggered significant public backlash and government scrutiny. Journalist Ida Tarbell published a detailed, damning investigation into Standard Oil's business practices in the early 1900s, and in 1911, the United States Supreme Court ruled that Standard Oil constituted an illegal monopoly under the Sherman Antitrust Act, ordering it broken up into 34 separate companies. In one of history's more remarkable financial ironies, this forced breakup actually made Rockefeller substantially wealthier, not poorer, because he held large ownership stakes in every single one of the resulting 34 companies, several of which, including what eventually became ExxonMobil and Chevron, went on to grow enormously as independent entities. By some historical estimates, Rockefeller's personal fortune peaked at roughly 1.5% of the entire United States economy at the time, a level of concentrated individual wealth that has never been matched since, making him, by most calculations, history's first person to accumulate a fortune equivalent to over $1 billion. This forced breakup offers a lesson in diversification that most people never connect to Rockefeller's story, but should. He did not fight to keep Standard Oil as one single unified entity out of pure sentiment. Once the legal outcome was certain, his ownership was distributed across 34 independent companies operating in different regions and under different management. And that involuntary diversification ended up protecting and even growing his overall wealth, because the failure or struggle of any single one of those 34 companies could no longer sink his entire fortune at once. Modern portfolio theory, developed decades later by economist Harry Markowitz, formalized this exact principle mathematically, that spreading capital across multiple independent assets reduces overall risk without necessarily reducing overall expected return, because the assets rarely all move in the same direction at the same time. If your entire financial future currently depends on one single employer, one single stock, or one single business, you are carrying a version of the exact concentration risk Rockefeller was involuntarily freed from in 1911, and that liberation, however forced, arguably made him even richer for it. In his later decades, Rockefeller shifted the same obsessive, systematic energy he had once applied to oil refining into large-scale philanthropy, founding the Rockefeller Foundation, funding the creation of the University of Chicago, and contributing directly to major advances in medical research and public health infrastructure that reshaped global health outcomes for the century that followed. He approached giving away his fortune with the identical rigor he had once applied to building it, insisting on data, measurable outcomes, and professional management rather than simple charitable impulse, effectively inventing much of what modern large-scale philanthropy still looks like today. It is worth noting that the habit which began this entire story, tithing 10% of a $300 annual income at age 16, scaled, structurally unchanged, into gifts that reshaped global medicine and education. The percentage-based discipline never changed. Only the number attached to it did. You just got paid, and the first thing that left your account was a bill. It does not have to stay that way. The boy who wrote every cent into a small red ledger was not protecting his money out of greed. He was building a system so precise that chaos, the same chaos his own father had subjected him to as a child, could never quietly drain his life again. He paid himself first before the world got the chance to take it from him. What would change in your finances if the very first thing that happened to every paycheck was a decision you made on purpose, instead of whatever was left over by accident? What would change in your finances if the very first thing that happened to every paycheck was a decision you made on purpose, instead of whatever was left over by accident? Most people look at a fortune like Rockefeller's and assume the lessons don't apply to them because the scale is entirely different. They tell themselves, I will start tracking every dollar when I have more dollars to track, or I will start investing when I have a massive surplus. But this is a fundamental misunderstanding of financial physics. Rockefeller did not build a system because he was rich. He became rich because he built the system when he was completely broke. The system itself is the engine, not the luxury product of wealth. When you look at your bank account today, you are looking at the lagging indicator of your past habits. If your immediate reflex upon receiving capital is to disperse it to everyone else, to the landlord, the subscription service, the credit card company, the utility provider, you are actively participating in your own financial disempowerment. You are playing defense in a game where the opposition never stops attacking. To shift from defense to offense, you have to adopt what behavioral economists call choice architecture, building an environment where doing the wrong thing with your money becomes difficult, and doing the right thing becomes automatic. Rockefeller did this with a manual red ledger because that was the technology of 1855. Today, you have an entire digital banking infrastructure at your fingertips, yet most people use it to automate their bills rather than their freedom. If you do not actively dictate where your money goes the second it arrives, modern marketing and the friction-free digital economy will dictate it for you. Algorithms are specifically engineered to predict your weaknesses, lower your friction to spend, and quietly drain your margin before you ever have the chance to pause and think. The only way to defeat an automated system designed to take your wealth is to build an automated system designed to keep it. The real transformation that happens when you take absolute, obsessive control of your unit economics is not just mathematical, it is deeply psychological. It changes your identity. The moment you decide that 10%, 20%, or even 5% of your income is entirely non-negotiable and belongs to your future self first, you stop viewing yourself as a consumer who merely works to pay off past debts. You become an investor. You start viewing money not as a tool for temporary comfort, but as raw capital meant for leverage and future production. You begin to look at every transaction not through the lens of, can I afford this right now? But, what is the long-term cost of this capital if I were to deploy it into an asset instead? That single shift in perspective is the exact line that separates the fatalistic locus of control from the Titan mindset. It is the boundary where financial anxiety ends and structural wealth begins. The ledger is waiting. The choice to step out of the chaos and into the order is entirely yours.